So what about those losses? Like what about people that are maybe have some losses that they have?
Right. So it's important to really understand the difference between different sorts of income. So not all income is created equal. So if you're a wage earner, you have a job, you get a W-2, that income is called ordinary income. Yep. And if you have investments are taxed differently. So if you have interest income, that's taxed as ordinary income, same as your wages. So you pay whatever your tax bracket is on that. If you have income that qualifies for preferential treatment, which would be qualified dividends or long-term capital gains, those are taxed at those lower rates that I mentioned before, the 0%, the 15%, or the 20%. So that's why it's important to work with your financial advisor to make sure that you are holding investments long enough so they do qualify for this preferential treatment. So there's a difference. Capital assets are basically your investments that you hold that are your stocks, your mutual funds, and so on, that if you buy them at one price and you sell them at another, it's either a loss or a gain when you sell it. And it's important to know the difference between long-term and short-term. So during the year and over the years, you have to count how long you've held these assets, because if you hold them for less than a year, you'll be taxed at the higher rates, your tax bracket, versus if you hold the investment for a year and a day, you'll qualify for the lower preferential treatment.
And that's definitely something you want to pay attention to and make sure if there's ways to
and there's ways to use those losses and those gains, because technically short terms and long term are grouped and tracked separately. So anything that you've held for a year or less is short term. Anything you've held for a year and a day is long term. But then they get combined, and so that's important to know. So for instance, maybe you have a year where your income's down. Maybe you are changing jobs. Maybe you got laid off. Things happen in your life, and your income levels go up and down. So then, if your income is lower, you talk to your financial advisor. You'd want to sell off assets that have appreciated and have gains, so that maybe you're in that lower or even 0% bracket. So if you're married, up to $77,000. You can sell long-term capital assets and qualify for that 0% rate.
Nice. And then that ties in as to the tax loss harvesting and what people look at usually.
Exactly.
Usually at the end of the year, people tend to look at that.
Right, and that's a great strategy to use.